Hi, everybody. This is Chris Englebert with Englebert Financial Advisers in beautiful Allentown, Pennsylvania with the weekly Englebert Angle. And this is the March investment strategy update. Now, the slide deck you are seeing, you can always get that slide deck if you would download my app by texting Chris E, C-H-R-I-S-E to 36260. That's Chris E to 36260. That downloads my app, and this slide deck is on my app. And every month we update it. But let's talk about the markets right now. Let's talk about what's going on, because there's a lot of stuff in the news, especially with the Fed and Jerome Powell this week. He spoke, gave testimony on Capitol Hill. And what's on every investor's mind? The increases in interest rates. So if you remember last year, the Fed increased short-term interest rates, and that's the only lever that they have, is the ability to control short-term interest rates. They don't control long-term interest rates, but typically long-term interest rates follow short-term interest rates. So with the big scare last year about inflation, the Fed cranked up short-term interest rates. And the question is, are they done yet this year? And we'll find out probably in the next couple of weeks to see if the Fed is going to pause or even possibly at the back half of 2023, lower interest rates. But the message that was given this week by the Fed is that they're going to keep interest rates up higher for longer. So what did that do with the stock market? Well, the good news is after a bad 2022, January, we saw the S&P 500 rocket ahead, almost 7.5% for the year. But again, as interest rates floated up in the month of February, we saw the S&P 500 pull back. And again, there's some very important resistance and support lines that are in place for the S&P 500. The 200-day moving average was touched a couple of times. We're above it right now. The question is, are we going to stay in a positive trend for the rest of the year? Tune in to see. But again, if you've been following our videos, I've been talking about how I believe that 2023 is going to be the year of the structurally fair stock market. And what I mean by that is we're going to have rallies and declines. When the market rallied up in January, we did take some profits on some individual stock positions. Our tactical account also got more conservative at the end of January. If we see a sell-off in the market down to that level of 3,400 to 3,500 on the S&P 500, you can be sure that we're going to be putting some cash back to work in equities. But let's talk about interest rates. I have two lines drawn here, a green one and a red one. So the 10-year Treasury finished the year at 3.88%. Then what ended up happening is that when it looked like inflation was cooling, we began to see interest rates on the 10-year float down to 3.25%. That's the green circle that you're seeing. But then we had a couple of hot inflation numbers come out in the month of February. We had Jerome Powell talk about increasing interest rates once again, and that's when you saw interest rates float back up to a little bit over 4% on the 10-year Treasury. Now, our view on interest rates is very similar to our view on the stock market this year, where we think interest rates stay in a rather narrow band, plus or minus 0.5%, right around 3.5%. So we could get up to 4.25%, possibly 4.5%, or we could get down to 3%. But we think interest rates stay in a rather narrow range. So one of the things I want to talk about is that a lot of market pundits are bemoaning the fact that the housing market is slowing down. Now, I wanted to show this chart because this is a history of mortgage rates in the United States. You can see in the 1970s, the average mortgage rate was almost 9%. In the 80s, it was almost 13%. But then you can see in the 2000s, we were at 6%. Then in the 2010s, 4%. And now in the 2020s, 3.9%. If you look at these ultra low rates that were down around 2.75 to 3% over the last 2 years, those are ultra low rates that we'll probably never see again. But the point that I want to make is that right now we're about 6.25% on a 30-year mortgage. That is the historical average for 30-year mortgages. So we're taking the other side of the trade and saying the housing market is not going to collapse because a lot of the market pundits are saying if the housing market collapses, that's going to cause the U.S. economy to roll over severely. Now, do we think some of the froth is being taken out of the housing markets in places like Austin, Texas, San Francisco, Los Angeles, New York City, Atlanta? Yes, absolutely. But the demand for homes is still there. We are still nationwide underbuilt by about 2 million homes out there. So again, we're going back to historic norms for mortgage rates, and we don't see that collapse in the housing market, which could potentially lead to a severe recession in the U.S. economy. But what we do see is we see that the jobs numbers are very strong. They remain strong. And so as long as the job numbers stay good, the probability of a recession keeps going down, or at least gets pushed out to later in 2023 or even 2024. So to sum it up for March, we saw February saw a pullback of 5%. We're stabilizing right now so far in the early part of March. Higher interest rates did stall the stock market out. In the next couple of months, we're going to see whether or not the Fed is going to raise 0.25%, 0.5%, et cetera. We'll have that clear delineation in the next month or two. But again, what's happening right now is high interest rates are competing for stock market money. And what we mean by that is, as of this video, you can get a one-year CD at 5.1%. So many investors are saying, why am I going to take risk in the stock market if I can get a one-year CD at 5%, 5.1%, and that is a very, very good argument. However, typically what seems to be the most obvious tends to not be the correct investment to make. If you're a short-term investor and you've got some short-term money, we are all for doing bank CDs right now. But we think this year the stock market's kind of in a range. We think dividend stocks are going to continue to do well. We think the bond market's going to continue to crank off 3.5% to 4% to 5% in bonds. And we think that this year is going to be, quote, a more normal year as far as rates of return go. So again, if you want to see this presentation, download my app by texting Chris E to 36260, and you can share my app with other people. And we appreciate it greatly for you viewing this video, and we'll be back soon.